This is Bروکس, and this is my price action trading course. This module is entitled, What is Price Action? Price action is any representation of price movement, and it's on any financial instrument, stocks, futures, bonds, it does not matter, and on any type of chart, a bar chart, a point and figure chart, a volume chart, a range chart, a raincoat chart, a candle chart. And it can also be on any time frame. So for example, on a candle chart, a 1-minute chart, a 5-minute chart, a daily chart, a monthly chart. Any movement on any of those charts is an example of price action. And price changes with every tick, and each change becomes an example of price action. When you're looking at charts, some things look very minor at first when you're watching them, but you should not dismiss anything. Everything that happens is happening because a group of institutions are making it happen. And our job is to follow what the institutions are doing. And if they're able to move the market, then you have to assume that something is significant happening with every tick up or down. So sometimes things look very unimportant, but they can lead to great trades. I believe that price action is genetically based. It's a reflection of human behavior, and our behavior is controlled by our genes. And I've looked back at charts for over 100 years, and the charts are the same. The price action on the charts are the same as they were long ago. And since I believe price action is a manifestation of human behavior and our chromosomes, it will continue to remain valid until we become a new species. On the right, here's a chart from the Great Depression, and if I didn't have the time on the bottom, you would assume it's a chart from today. On the left, there's a chart of World War II. Again, the patterns look the same as they do today. Crashes are common. 1987, most of us were around in 1987, and this is a daily bar chart of General Electric during the crash of 1987. Big bear spike and then a triangle. It looks pretty much the same as this 5-minute chart of Costco. A big bear spike and then some kind of a pullback. And the same as a 1-minute chart of the E-mini. And you see this every day. The E-mini crashes every day on small enough time frames. So there's nothing special about a crash. In terms of price action, it's the same on all time frames. When you start out as a trader, you look for information, and you'll look at the internet, you'll find websites, you'll find videos, you buy books, you read books, and I think it's easy to be struck by just how much information there is out there about candlestick patterns. And I think the message is clear to somebody starting out, that candlestick patterns can make you rich, and that they're the key to success. However, you correctly believe that Goldman Sachs, high-frequency trading firms, and hedge funds make a fortune, and that they are not using candlestick patterns to do so. High-frequency trading firms, for the most part, are using tick charts, so they don't see candles at all. And most of the hedge funds are using a combination of technical and fundamental things. Goldman Sachs has some fundamental traders and some technical traders, and I really doubt that they're paying much attention to candlestick patterns. So if the big players on Wall Street are making a fortune and they're not using candlestick patterns, should candlestick patterns be the cornerstone of your trading business? I don't think so. You know, just watch CNBC anytime, watch Options Action, watch Fast Money, watch any of their shows, and they'll have lots of successful day traders come on and talk about their trades, and they constantly talk about the trend, and they'll talk about channels. Oh, it's near the bottom of the channel, a good place to buy. Prior highs and lows. Oh, it's pulling back. This bull trend is pulling back to that old high. This is support. I'm going to buy there. Do you ever hear them say that they sold a bull trend because there was a dark cloud cover or a shooting star or a harami pattern? No, you don't hear it because that's not what they're doing. Let me give you an example of a candlestick top in a bull trend. Can you make money from it? Absolutely. How do you make money on a candlestick top in a bull trend? Well, first of all, you don't sell it. You wait a few bars, figure out where the bears will exit with their losses, and you place a buy stop to get long just where they're getting stopped out. And that's how you make money using a candlestick top. You bet that it's going to fail, because most tops fail, and you should get long where the trapped bears are taking their losses. Here's an example of Apple daily chart. There is a bearish engulfing pattern, very strong bear bar, a standard candlestick topping pattern. So, should you sell the close of the bar? Should you sell below the low of the bar? Well, on fast money on that day, what I heard were traders saying, Apple sold off $20, and the last few times that it sold off $20, it rallied. I'm going to buy. And they were correct. Okay? So those traders on fast money were buying down here at the close of this bar around the moving average. They don't use the 20 bar exponential moving average like I do, but to me that's a buy. The market has not touched the moving average in 20 or 30 bars, and it's a strong bull trend, possibly forming a trading range, but in any case, if it is, it's near the bottom. So instead of looking at this wonderful reversal pattern and saying, wow, I better sell this candlestick pattern, because I saw on the internet that it's a great top. Well, in fact, most experienced traders would see just the opposite of what you're seeing, and they would say that, it's a bull trend. Most reversal patterns will fail, and they'll become bull flags, and it's far better to look to buy the pattern than it is to sell. And this is what followed. A pretty strong rally, and the traders who bought the pullback did quite well. The market tends to have inertia. It tends to continue what it's been doing. If you want to see what the bars to the right look like, just look to the left. Right? The market tends to continue what it's been doing. And if you're in a bull trend, 80% of tops will fail and become bull flags. If you're in a bear trend, 80% of bottoms will fail and become bear flags. If you're in a trading range, 80% of breakout attempts up and down will fail, and the market will reverse and go to the opposite end of the trading range. So there's much more to a top or to a bottom than a candlestick pattern. And in fact, candlestick patterns are not necessary at all to make money. And my guess is most of the very best traders on Wall Street don't pay any attention to the candlestick patterns. Trading is very difficult, and every trader learns quickly that it's easy to lose money, and they do lose money, no matter how hard they try. They read, they study, they watch television shows, they take online courses, they hire tutors, they go to conferences. They try really, really hard to do this, yet no matter how hard they try, they lose, and they lose for a long time. And it does not matter how much they know about candlestick patterns. And so candlestick patterns are not all that helpful. In a way, they're like a false guard. After losing enough money, people tend to get desperate, and they're desperate to believe in anything. Will you please help me? This person says he's an expert. I'm going to go follow what he's preaching. And many of these people are well-intentioned, right? And they preach that candlestick patterns are the road to financial heaven. And they're trying to be helpful, and they really believe it. But there's really much, much more to trading than candlestick patterns, and candlestick patterns are not even necessary to the success of a technical trader. They're one of the least important aspects of trading. Just listen to what the traders on CNBC tell you, and they tell you this every day. They talk about why they're taking trades, and you never hear them talk about candlestick patterns. What you hear them talk about is, the market's near the bottom of a channel, I'm going to buy. It broke out, and now it's pulling back to that prior high. That prior high is now support, I'm going to buy. oh, it broke to the downside and now it's coming back to the bottom of the upper trading range, therefore it's approaching resistance, I'm going to sell. They also talk about whether the trend is strong. Is the market continuing to make higher highs and lows in a bull, or is it making lower highs and lower lows in a bear? This is the stuff that they're talking about. They're not talking about harami patterns, dark cloud covers, hanging man patterns. And why is that? Because those things don't help them make money, or at least they don't help nearly as much as these things. These are the keys to making money, not candlestick patterns. You also hear them assess buying and selling pressure. They may not use the terms buying and selling pressure, but they'll talk about, oh, the trend looks really strong. The bull trend looks strong, or the bear trend looks strong. And they'll also talk about risk and reward and probability. Every now and then they'll specifically mention the three together in the same sentence. That, yeah, the risk is small and the probability is small, but the reward is so huge that the trade makes mathematical sense. You'll especially hear option traders talk about that, where they'll take a trade that has very little chance of success, but they feel the reward is so much greater than the risk that the trade is worthwhile. And another very important thing is trade management. What do you do once you're in a trade? Do you trail your stops? How do you trail your stops? Do you scale into a trade going against you? Every now and then you'll hear them on television say, yeah, I bought and it's falling, I'm going to buy more. And they're not saying, oh, I bought a bottom, a candlestick pattern, and now it fell and there's another candlestick pattern and I'll buy more. What they're saying is, no, I think the trend is up and that this is just a pullback and we're in a support area and therefore I think the trend should resume, because 80% of the time that's what trends do. You need all of that and more to be a successful trader, and candlestick patterns are totally unnecessary. They can be useful, but they're a small piece of the big picture. When you hear people talk about setups, I'm looking for a buy setup. All you get from the internet is they're looking for a candlestick pattern. The candlestick pattern is the signal. The setup is made of two things. It's made up of the signal, the candlestick pattern, for example, and the context, all of the bars to the left, all of the things that I just mentioned, all that support and resistance. And you cannot be successful as a trader without all of that stuff to the left, all the support and resistance. You can be successful as a trader without candlestick patterns and without the signal. So, the context is far more important than the signal. Both go into making a setup, and the best setups have a strong context, like buying near support, selling near resistance, and a good signal bar to help trigger the trade. But the signal bar is just it's just helpful. It's not necessary. And you can buy a strong bear bar, the close of a strong bear bar in a bull trend, even though there's no candlestick buy signal. You can sell the close of a strong bull bar in a strong bear trend, even though there's no candlestick sell signal. The context, what took place to the left, is far more important than what took place over the past bar or two or three with the candles. Okay, trading can make you rich, right? However, this is not the way to do it. When I first started trading 25 years ago, this is pretty much what I did. I put many indicators on my charts and hoped that they would make me rich, and I lost money. And one day I decided to get rid of all the indicators and just look at the charts. And this is that same chart that I just showed a minute ago, but without all the indicators on the chart. And when you look at it this way, it looks pretty clear. We have a decent looking wedge over here, and then a bull spike, and then a pullback from the breakout of the wedge, and then a double bottom bull flag, another breakout, and another pullback. So if you get rid of all the indicators and just look at the chart, just look at the price action itself, a lot of times you'll see things that you cannot see when you have the indicators present. And you don't have to look at the 5-minute chart. You can look at any kind of a chart. For example, here's the same chart where there's 1,000 ticks per bar, and the overall shape is still the same. The price action is still the same. Okay, here's another version of the chart where there are 300,000 shares per bar. And again, the price action is the same. Here's our range chart. This is a range chart of the same 5-minute chart of Petrobras PBR. And again, the same basic structure is present on this chart as was present on the other charts. It does not matter what type of chart you use. All they are is representing human behavior. Monthly chart, Petrobras. Okay, again, basic price action is the same. Parabolic buy climax, the final flag, strong bear spike, pullback, test of the low, and there are tradable patterns all the way through the chart. This is the end of the module entitled "What is Price Action?"